Crypto is high risk and high return. The more return you want, the more risk you have to take. But I'm not sure if that's actually true. I think most people think about risk very, very wrongly. I think the concept of risk is measured in the wrong way. Most people have it backwards. Most people think that risk is measured by how much a price goes up and down. Right? Some people think that the volatility of an asset, the volatility of the expected returns, is a measure of risk. If something is relatively stable in price, it's relatively low risk. If something is not so stable in price, then it's high risk. And because Bitcoin can drop 60, 70% from the all-time high, it's considered high risk. But is that really a good measure? Is volatility a good measure for risk? I don't think so. Because just think about it, right? You can very easily financially engineer a return profile that most of the days looks very, very nice, where you don't have a lot of volatility, but where you simply have all your risk in the tail case. As in, you put a lot of risk in this maybe 1 out of 100 cases where you lose everything, and for all the other cases you tend to win. You could design a roulette table where in 1 or 2 numbers you lose everything, and for all the other numbers you win maybe 0.5%. You simply just have enough total losses, maybe in 3-4% of cases you've got total loss, but in all the other cases you've got a slight gain. This could still be positive for the casino. And you would think most of the time you would think everything is fine because you're winning a little bit every time you play the game. This, I think, is pretty much how a lot of the traditional markets work. Very often you think everything is fine, your returns seem to be okay, and then out of nowhere comes the black swan event. Out of nowhere comes the financial crisis or the mortgage crisis or whatever random crisis you have of the day. And then comes all the money printing that brings us all out of that crisis, which is simply just an accounting trick. You devalue the US dollar, and so on paper you've got, again, more dollars, but in real purchasing power you're actually poorer. Now, how is Bitcoin changing this? Or how is crypto changing this? I think crypto is the only asset that doesn't get bailed out, the only major asset that doesn't get bailed out by governments. And so when there is a liquidity crunch, we actually see this in the price. We actually see all the risk displayed in front of us. But if you believe in the asset long term, you can buy the dip, right? You can actually take advantage of those big drops. Now, you don't have this skewed return profile for Bitcoin. You've got a pretty nice bell curve, as in sometimes you earn a lot in a year, sometimes you lose a lot in a year, but it's all transparent. There's no magic crash that suddenly surprises everyone. Right? We simply just have bear markets and we've got bull markets. But when you look, for example, at the stock market, the crashes tend to happen way, way faster than the days where we gain money. In other words, there's a lot of tail risk, a lot of risk that a lot of people aren't aware of in traditional markets, but you don't have it that much in the crypto markets. And that's what I like about crypto, right? I like that there doesn't seem to be that much manipulation. The risk is more open. It's more open in the wild. I personally think a way better way to think about risk, even though it's harder to quantify, is to think about what are the unknowns. So in traditional finance, you've got a ton of unknowns because you've got a lot of systems that are very hard to grasp. You've got the interbank lending market. You've got interest rate adjustments where you don't know what's going to happen. You've got very complex financial engineering with the derivatives market. You've got a mortgage market with not very transparent numbers. We've got all kinds of different systems playing with one another that all influence one another. And it's very hard to get a grasp of what's actually going on. A lot of those markets also don't have very transparent data, right? You don't really know who holds that particular asset, right? If, let's say, a whale in the property market would start dumping commercial real estate, right? How much could he actually impact the price of all of commercial real estate? We don't know, right? It's not as transparent. But for the blockchain, everything is very transparent. We know what whale owns how many Bitcoin. We know what are the whales doing. Are they currently accumulating or are they currently selling? We know what's the average holding duration of a Bitcoin. We know all those things. And because of that transparency, we can measure risk better. So we don't have as many unknowns. The risk lies in the unknowns. And that's why this idea of high risk, high return, low risk, low return is also somewhat misleading, because what you know about a certain asset might be very different from what I might know about a certain asset. If I know more about the asset, then my personal risk for that asset is lowered. And the regulator obviously knows about this, right? That's why insider trading is illegal. But on the other hand, there is a gray zone, right? There is a zone of the well-informed investor, the investor that knows more than the average market participant, that can thus have a better risk to return profile, but that still doesn't use illegally obtained information. So this is how you have to think about this, right? If you want to get a better risk to reward ratio for any investment, the best way to do this is to simply just learn more about the asset. If you want to outperform the market, say in properties, you have to know a lot about the property market in that area. You have to know where the demand is going, where the supply is going. Is there a new development, new property development happening around the corner? Are there a lot of people moving into the part of town that you consider buying? What about the specific development that you consider buying within that area, right? Is this something that's very well sought after? So simply just knowing more gives you an edge in the market and leads you to better decisions. And that's in the end the message of this video, right? Don't think about risk just as a number of fluctuating prices. Think about risk in terms of what do I not know and what could I potentially know. The more you know about something, the lower you have your risk personally for that asset, and the better the risk to reward ratio comes. You can never eliminate this, right? There's always a luck component. You never know what the weather is going to be tomorrow. You never know what will be the immigration laws in your country. You never know where the interest rates might go in, say, a year or two. So there are unknowns, but there are also potential unknowns that you can eliminate. And that's simply eliminated by learning more, by putting in the effort. The person that puts in most effort in investing, the person that learns most about a certain asset, is going to be the person that's most likely to outperform and is most likely going to make the gains. So with that, hope you continue watching this channel. Hope you're being subscribed. A like would be very much appreciated as well. See you next time. Cheers.